I'm Abby, and welcome back to Wisdom Wednesday. Today I'm with Sam the Mortgage Man, and grow your minds with us while we tackle our essential question, closing costs. What are they? So, Sam, last week we talked about the loan program called FHA. Now we're talking about closing costs. What exactly are closing costs?
Well, closing costs are costs associated with closing a mortgage loan. There are a lot of fees that aren't just lender fees. There's additional fees they call mutual third-party fees. These fees are usually anywhere from 2 to 2.5% of your loan amount in order to get the loan closed. Such fees are going to be title, escrow, processing, underwriting, notary, appraisal, prepaid interest, setting up your impound account for your taxes and insurance per month as part of your monthly payment. Some people argue that these fees are not mandatory as far as all of them go. They are called recurring or non-recurring closing costs. But as far as I'm concerned, the closing costs are costs you have to be aware of because you have to somehow, 80% of these costs come in with them to close the transaction.
Okay, wow. Hold up right there. So now I have to have down payment money and closing costs and money to buy a home?
Yes. So as we talked about last video, you have to come up with a down payment. For example, with FHA, it's 3.5%. You can get a gift. You can withdraw money from your 401k. You can save the money. You know, there's ways to do that. As far as closing costs go, there's really 3 ways to pay closing costs. You can either pay it yourself through some of those ways we talked about how you pay your down payment. You can ask the seller for a closing cost credit. So basically when you write an offer, let's say you're going to write an offer at $300,000 for a home you're interested in, or $500,000 for round numbers. You go up to $510,000, you ask the seller for a $10,000 seller closing cost credit. Technically you're financing that money, but it's just $10,000 for the closing costs you're not coming in with out of your pocket above and beyond your down payment. You following me?
Yes.
Okay, so that's another way to do it. So you can pay for it out of your pocket, you can do a seller credit, or a third, there's ways where we can do what's called a lender credit to help pay for the closing costs. The lender credit ultimately will affect your interest rate. So instead of maybe getting a 4% interest rate, I can give you a 4.5% interest rate and give you a $7,000 lender credit towards closing costs. So that's another way you can pay for closing costs without having to come up with additional monies past your down payment. Now, granted, you know, the interest rate that I just gave does not necessarily mean that's the going market rates when you see this video, and it does not mean that that rate automatically comes with that credit. So it's all contingent, your criteria, what the going market is for the interest rates and stuff like that. But again, 3 ways to pay for closing costs: yourself, seller credit when you make an offer, or lender credit which dictates your interest rate.
Thank you for the information, Sam.
You're welcome.
Don't forget to watch our next Wisdom Wednesday, where we'll be keeping it simple. Bye!